So if I'm going to make a channel about trading stock options, I might as well have some basics here. So in this video, we're going to talk about what is a stock option. Maybe you have some preconceived notion from TV shows or movies or even CNBC as to what a stock option is, how risky it is, etc. Maybe you've heard stories in the media about people getting themselves in some financial trouble because of stock options. Today, we're going to try to break it down and look under the covers. What is a stock option? There are risky elements to it, and there are not some risky elements to it. So let's get into it. Now, I'm going to make the analogy that a stock option is like any other type of insurance contract. You can have house insurance and car insurance and boat insurance and life insurance. A stock option is stock insurance. The seller of the stock option is offering insurance in effectively insuring the price of the underlying stock from increasing or decreasing as the case may be. The person who buys the stock option is purchasing insurance against the movements of a stock option's price. Now, there's a related term called hedging, and you may have heard of this. There are things called hedge funds, or you may have just heard of people hedging their bets. Effectively, hedging in a generic sense is any type of asset that you own that you're willing to pay a little bit of money to ensure the downside of that. So you own a car, but you purchase car insurance in case your car gets stolen. The car is worth a lot. The insurance doesn't cost you very much. And so it makes sense to do that. And so hedging in a general sense is anyone who has a large quantity of something who wants to bet on the other side to protect themselves. You'll see this in something like the oil market, where oil producers might want to, they're going to produce oil for the next 2 years, and so they're going to buy some oil futures to protect themselves from the falling price of oil. And on the other side, oil consumers, big refineries and companies like that, might purchase futures on oil so that they guarantee the price that they pay well into the future. So they protect themselves from the fluctuations of those prices. Now, in the stock option game, you can be the buyer or you can be the seller. So you can either purchase the stock option insurance or you can actually what they call sell it or create out of thin air stock option insurance. Now, that might sound crazy. We all are purchasers of insurance in our life, but whoever writes insurance, whoever creates insurance, none of us do, but when you create a stock option, you sell a stock option, that's what you're doing. The reason they would do that is for the money. So when you sell a stock option, someone else is buying that from you, and you get to collect that as a premium. Just like in a car insurance, you pay an annual premium, maybe you pay it every month, and if you don't get into any accident, the insurance company keeps that money. They don't refund you the money at the end of the accident. Now, similar to a car insurance contract, you also have a deductible. So if you want to collect on your insurance, it might also cost you something out of pocket. So there's some disincentive for you to just go around crashing your car. Now, back to stock options, there are two types of options. One is called a call option. Call option gives the person who purchased it the right, but not the obligation, to buy the underlying stock at a set price anytime before the expiry date. The opposite of that is the put option, which gives the buyer the right, but not the obligation, to sell their stock at a set price before the expiry date. There are 4 components to a stock option. So whenever you're talking about a stock option, there are 4 things that need to be known. Otherwise, we're not talking about anything. Those are 4 properties. The underlying stock, the strike price, or the price at which the option can be executed, the expiry date, which is the deadline to use the option after which it expires worthless, and whether it's a call or a put. Now, a couple of quick facts. I checked the Chicago Board of Options Exchange, which is where options are traded. And they do say only about 10% of stock options are exercised. So out of all of the thousands of options that are sold every day, by the time the expiry date comes, about 10% of them are actually exercised. Now, some people turn around and say, well, that means 90% of options expire worthless, but that's not necessarily true. Now, myself, I typically close out a trade before the trade is over. So I will buy back any options that I sold or sell an option that I purchased, because executing an option is more expensive. At my broker, at least, there's a $25 charge to execute an option. And so typically I just want the money and I don't necessarily want the stock. So 50% of them are exercised, 10% of them, 10% of them exercise, 50% of them are closed. That means about 40% of them expire worthless. Here's an example. You might see on this channel me talking about Digital Ally, DGLY. Remember, I said there are 4 components to a stock option. So DGLY is the underlying stock. $5 is the strike price. It expires on July 17, 2020, and it's a call option. So I have sold many of these options from various months so far on this channel, and I buy them back and sell other months. So let's talk about a more concrete example. Let's talk about Facebook. Now, you might be familiar with Facebook. The ticker symbol is FB. I pull up a 5-year chart from Facebook, and I'm no stock picker, and this is not stock picking advice. But Facebook has generally had a strong momentum up and to the right. Year after year after year, the stock price goes higher. Couple of dips in 2019, and again here in the pandemic era of 2020, but generally it's up. Now, you can buy and sell options on Facebook. Here's an example of the expiry dates that are available. So you can't just choose any expiry date. You have to choose the ones that the market offers. So in case of Facebook, there are a couple of dozen dates to choose from. Everything from, now that was the same date, June 19th. There are weekly options. So every Friday, Facebook has an option expiry date, and there are monthly options. And so we can see August 21st is 63 days from now, September, November, December. And the options can even go into future years. So as we scroll down a bit, we can see 2021 options, January, March, June, and January 2022 options. So you can buy options for Facebook for up to 2 years in the future. And September 2022 is 800 days. Now, not all the stocks offered so many options. Facebook, I guess, is heavily traded and is worth offering. Now, if I choose one of these dates, I chose August here. Now, I'm not zoomed in, I'm zoomed quite out, but you can just see, even within a single month, there are dozens and dozens of strike prices to choose from. I'm going to zoom in a little bit, and we can see in this one, I've got the 235 strike, which is the option is insuring at $235. And we're going to sort of ignore these numbers. You can see on the left, it says 2620. That's the bid price. 2670 is the ask price for this option. For $26.70, you can purchase an option for August that will give you the right, but not the obligation, to buy Facebook for $235. We can see at the top, Facebook is currently selling for $237. So you can even buy options that are already in the money, as they say. So this option, the $235, I can execute it tomorrow. Now, that would be a waste of a lot of money because there's only $2 difference, and I'm paying $26 for that. So you can see that this insurance contract is kind of expensive in my view. And the stock is really going to have to move into the $250 to $260 range for it to be worth it for me to exercise it soon. Right? There's a lot of value in there still to come. So if you wanted to buy that, you would have the right to buy Facebook for $235, and that would cost you $26.70. Oh, sorry, that was the December 18th, 2020 price. So if you wanted it, you could do it. I'm not advising you to, but that is something that you can do. Let's look at the alternatives, right? So you can buy this stock. If you are bullish on Facebook and you think, you know what, by the end of the year, Facebook should go up, you have the option of buying the stock, or you can buy a call option. If you buy the stock, the profits and losses are quite clear. If the stock price goes down to $200 by the end of the year, you will lose $37 and that'd be down 15%. Of course, you don't lose the money till you sell it, but your position would be down if Facebook was to fall. Similarly, if Facebook was to go up to $300, you would be up to $63 because you'd be up to 27%. So the stock price going up and going down is quite linear, quite straightforward. If instead of buying the stock, you decided to buy the call option, first significant thing to know is the call option is 90% cheaper than the stock option. So the stock is $237. The call option is $26. That's about 90% less. Now, the bet that you're making, though, is if the stock was to go down, the option expires worthless. And so you'll lose that $26, a 100% loss on your $26.70. If the stock was to stay exactly the same, now it's a $235 stock option, so that would have a value of $2. And so you would have paid $26 and you would have a value of $2. And so you would lose $24, effectively 100%, almost 90+% of your purchase if the stock doesn't move. But if the stock goes up to $300, then your call option was to be more than double the value. So it was from $26 where you purchased it to a $39 value at the end of December, and that's 150% of your purchase price. So you can see the call option has a more complicated pricing structure, profit and loss structure, but the potential to make a higher percentage return is greater for the same movement of the stock. And your investment is a lot less. So instead of having to risk $237, tie up $237 of your investment account, you only have to risk $26. So a call option in this case allows you to bet on the direction and timing of your stock price movement for a lot less than the underlying stock price. Now you might think, what's the downside, right? If I can just purchase a stock option for 90% less than the cost of the stock, why doesn't everyone do that? Well, the thing is, stocks are not guaranteed to go up or down. And so you not only have to be right in terms of the direction, but also in terms of the timing. And also, if the stock doesn't move, you're generally going to lose unless you put in a particular position that relies on the stock not moving. Now, there's a thing called volatility. And so some stocks have more expensive options than others. So volatility is priced into the option. If we looked at Facebook, we see this $235 call. We would have paid, now the price changes from time that I took the screenshot, but $26.50 now. And there's a volatility of 37%. So we can expect the stock to move 37% higher or lower in one standard deviation. Something like that, right? And so that's why you're going to pay $26. If you take a more volatile stock like Tesla, TSLA, the implied volatility is 68%, which is almost double. And the option price is crazy, $190 for an at-the-money Tesla option, right? So for at-the-money Tesla option, you're going to pay $190. It's kind of interesting. So to summarize, an option is a contract between a buyer and a seller that allows you to basically bet or buy insurance on the price of the underlying stock based on an expiry date. The buyer pays a premium to the seller, which the seller gets to keep no matter what. If the option expires out of the money, it's worthless. And again, something like 40 or 50% of options expire worthless. If the option is in the money, then the owner can exercise that at any time. And again, 10% of options are exercised. So it's rarely exercised before the expiry date. So if you purchase a December option and it's July, you've got a 99.99% chance you're not going to get exercised on. But as you get closer to December, that chance becomes greater. The trick with options is finding a strategy, finding the underlying, finding the, making a intelligent decision based on the direction and the timing of price changes, and figuring out what strategy. Anyways, that one a bit longer than I expected, but that's the basics of stock options. I'm going to be referring to this video whenever I'm talking about different strategies. I'll just say, come check out my introductory video. So that's why I recorded this. I'm not a professional trader. Do not do anything that I tell you that I'm going to do for myself. I'm not recommending stocks. I'm not professional. I've got no training in this. You would be foolish to follow my financial advice without doing your own due diligence. So I've said all that, and hopefully you listen. Thanks.